We have seen episodes where people have burned fingers also.
Yeah. Now, if you look at last 25-30 years, slowly mutual fund has become traditional. So now, if you look at market keeps moving up and down, investors are okay, and alternate is coming like alternate. So I think one of the key reasons why this market did not get developed, because one platform which had a tax benefit, other platforms did not have. Now everyone is at an equal footing. I think it's very critical that you diversify. I saw it yesterday, some 7-8 companies, marquee names, last 5 year return is zero. Companies are fantastic. They have been growing. Their profits have doubled over the last 5 years. But guess what? The equity market has given 0% return. They are stopped. We are a 77 years old company. We started way back in 1947, and that's when India got independence.
So today we have between us Mr. Santosh Kamath. I've known Santosh since almost 2 decades now, and he's been one of the best credit fund managers I have known in my career. And today's topic is very interesting. Not that a lot of people are talking about it, because I think last 4-5 years it's been all about equities. And somewhere, credits and bonds have taken a back seat. With the last 1 year, the markets have corrected, and we've seen that, why asset allocation becomes so important. And especially the credit space, which is a very interesting space. But because of certain previous experiences what people had, as well as, the risks attached with it, okay, be it in form of liquidity or in case of delinquencies, I think that space is something which is not talked too much about, and the investors also don't know how to approach this space. So Santosh, my first question to you is, could you tell us more about credits, especially, because this is one space where I feel, people have not, it's an underinvested space, okay, from investors' point of view, as well as, we have seen episodes where people have burned fingers also, in fact. Yeah. So could you tell a bit more about this space specifically?
Yep. So before that, thank you very much for inviting me on the show. You said you know me for the last 20 years. Many of your investors may not. So let me self-introduce myself. I'm Santosh Kamath. I work with Franklin Templeton. I'm sure all of you heard about Franklin Templeton. Many of you may have heard about Franklin Templeton. But many of us may not know the history of Franklin Templeton. We are a 77 years old company. We started way back in 1947, and that's when India got independence. So, we are as old as the modern India. We have close to $1.6 trillion in AUM. Just to put that number in perspective, it's more than double the entire Indian mutual fund industry's AUM. We have presence in about 60 countries. In India, frankly, we were one of the early foreign investors to come into India. In India, we have been present for close to 30 years now. We run a large mutual fund book, and now we are going up to the alternate side. Now, typically people think Franklin Templeton, they hear about Franklin Templeton, they think it's a mutual fund company. But I think this data you may also not have. Today, we are among the 10 largest US companies in alternate funds. We have close to $250 billion, more than $250 billion in alternate asset. We have seen as a company, we have seen a shift from mutual fund to alternate. And why? Because that's the way the industry is moving. And typically we have seen what happens to US or Western countries over a period of time. We see that happening in the emerging markets also. I think India is at that cusp where alternates is going to be a big story going forward. You mentioned about credit, that it's kind of not too much known in the market. If you think back, so I joined this industry way back in 1993. There was the first time a private mutual fund was coming up as an open-ended fund. Kothari Pioneer, I don't know if you know this, was the first private sector fund to open an open-ended fund, to start an open-ended fund. So at that point of time, I remember your FD was supposed to be a traditional investment, and mutual fund actually was quote-unquote alternates. Mutual fund was complicated, there were too many schemes, too many understanding, NAV, open-ended fund, redemption, exit load, and it was very complicated. Now, if you look at last 25-30 years, slowly, mutual fund has become traditional. So now if you look at market keeps moving up and down, investors are okay, and alternate is coming like alternate. So what was alternate earlier has become traditional, and the alternate is coming as an alternate. So today, if you talk about alternate funds, the typical people will have a view that, oh, it's complicated, we don't know much, it's a high risk, something very similar what we talked about mutual fund maybe 30 years back. Now, if you look from the saver's perspective, India as a country has always been a very good high saving country. Earlier, capital market was not too developed, so almost all the money used to go into banking system. So FD was your parents, my parents, recurring deposit, post office scheme, Indira Vikas Patra, Kisan Vikas Patra, and so on and so forth. Over a period of time, capital market got opened up. The biggest thing India did to get money in the mutual fund was the tax benefit given to the fixed income investors. So if you, at that point of time, if you had invested for 1 year early, before the 3-year time frame came, you would get indexation benefit, and then the tax is applicable, and therefore the net tax was significantly lower. Over a period of time, that got changed to 3 years, saying that if you stay put for 3 years, you pay significant low amount of tax. I think that was one of the key factors, according to me, that fixed income market got developed on the AAA side for mutual funds. And large part of the money start coming in the mutual fund. Equity was always less taxed, and therefore equity was anyway okay. So what was positive for mutual fund fixed income schemes? Actually, according to me, now this is a slightly more controversial statement, it actually became negative for non-AAA market. Why? Because mutual fund as a platform got the tax benefit. Now, if you look at any asset class, typically the asset class gets a tax benefit. So if you want to invest in equity, you buy directly, you buy through PMS, you buy through AIF, you buy through mutual fund, more or less the taxation is the same. When mutual fund had tax benefit on fixed income, you invest directly in bonds, you pay full tax. You put money in bank deposit, full tax. PMS, full tax. AIF, full tax. Mutual funds, 3 years, zero tax, close to zero tax. So what happened? The money started going to mutual fund were buying AAA, and that market became extremely liquid. Thousands of crores of deals can happen quickly. But because of that, the alternate funds could not get developed, PMS could not get developed, direct bonds did not get developed. Guess what? 2023, government said enough, now we'll take off that tax benefit to the mutual fund. Obviously, big negative for the mutual fund industry as such. But according to me, very good for the market to get more liquid, because you have alternate funds, you have PMS, you have direct bonds coming up. So I think one of the key reasons why this market did not get developed, because one platform which had a tax benefit, other platforms did not have, now everyone is at equal footing. So that I think now, obviously, it becomes a big story going forward. Unfortunately for the fixed income market, when the tax law got changed, fortunately, equity markets start doing very well. So while on one side the debt is taxed higher, and guess what, the equity, which is a competitor to debt, are actually giving you more returns. And therefore we saw, I think, a bit of skew that more money started going towards the equity funds. Now with people understanding the volatility in equity, asset allocation becomes the key, and now you look at debt. Now many people ask me that, debt has risk, right? And as if other asset classes don't have risk. So I was in a meeting somewhere and said, sir, debt has a good amount of risk. I thought only invest in gold. Gold is the least risk. So I reminded the gentleman that, I don't know whether many people know this, from 2011, I think at that point of time, gold was quoting at maybe $2,000. In 5-6 years, I remember 2011, 2016 or something, it went to $1,000. A 50% fall in gold prices. Next 5 years, again, it went back to 2,000. So for 10 years, 2011 to maybe 2020, gold gave 0% return. And this is US dollar terms. Obviously, rupee depreciated, and therefore there will have been some return. So if gold can give you 0% return for 10 years, and silver, even if you don't ask, I think 2011, I think it was close to $45, $46. I think by, I don't remember the exact year, in 5-6 years, it went to close to $12. 75% fall in silver prices. Now you see gold and silver are rallied up sharply. So what I'm trying to bring out the point is, every asset class will go through ups and downs. If you buy the wrong cycle, obviously you will make less returns. If you buy the right cycle, you make good returns. But who knows the cycle? It's very difficult to predict. And therefore, you need to have asset allocation. So you put some money in equity, some money you put in AAA liquid, so that you can use that for liquidity purposes. If you have some money which you can allocate for 3-4 years in a closed-ended structure, and in that bargain you want to get a slightly higher yield with a moderate risk, then alternate comes in. Now the good part for alternate fund is that the spectrum is wide open. You can have very low risk in alternate, medium risk in alternate, and very high risk in alternate. So alternate is just a platform. So just because a scheme is coming up alternate, investors should not think, oh, it's very high risk. Because theoretically speaking, alternates can buy AAA assets. What will stop them? So I think one should look at the perspective that diversification is the key. with so much of event happening world over. You can imagine from geopolitical risk to economic risk to tariffs and so on and so forth. I think it's very critical that you diversify. Second, if you want to get higher returns, you have to take some risk. So either you take interest rate risk or credit risk in the fixed income space. Interest rate risk, obviously the interest rates can go up and down, and therefore your returns can be up and low. You take credit risk, which means that you get a higher yield, but there's some chance that some company may get downgraded, some company may get defaulted, and therefore your returns can get impacted. So that's a broad thing I would want to talk about this one.
So credit specifically, like you mentioned, that it is something which is not developed because of the certain reasons of taxation, as well as the equity market started doing well.
Right.
Out of the 3-4 things which I could just sum it up was one. Investors typically look at a rear view mirror approach, so they will always try to follow
Absolutely, yeah.
returns. So that's one thing which is there. Second is that because of tax laws, now not in favor of mutual funds.
Right.
Typically, investors are just not going beyond liquid and liquid and money market funds.
Right.
They're not going and putting money into the into long only mutual funds.
Yeah.
In fact, second thing is the third thing is that what we have seen in these last 2-3 years is that you have a lot of hybrids also which have come. In fact, and I think as a space again, where people feel that hybrids are safe. I think if another 1 year of bad markets, I'm sure hybrids also will start underperforming.
Yeah.
So credit as a space becomes important, but within the fixed income space. So typically an asset allocation is always going to be between debt, equity.
Yep.
Now within equity, it can be direct equity, mutual funds, PMS, or foreign equity, whatever it is, international equity. Within fixed income, okay, you have one is the AAA rated high quality bonds, okay, and then you have credit.
Correct.
Unfortunately, this is the space where the risk is also quite high, because in equities you may see markets. It will be a function of markets. So you may get a mark-to-market gain or a loss.
Right.
You may end up losing money if you really go and buy a very bad company.
Correct.
But in case of credits,
right.
and that is my second question to you is,
right.
You can lose the complete principal also. In fact, if there is a delinquency. So it's a little different, this question actually. I'll put it in 2 parts. So, one, based on the risk. Okay. That when you have this kind of a risk where you can, specifically in unrated papers, unlisted papers, as well as the lower end where you end up getting a double-digit return.
Right.
Okay. What is the risk and how do you actually tackle it?
Right.
Okay. Second question is to do with basically the liquidity portion. In fact.
Right.
And so how could you answer this in form of what is the risk attached and how do you tackle it as a fund manager, because I think the fund manager's role becomes very important.
Right.
A AAA rated, I think, fund manager's role, we do have episodes like Island FS where it was AAA rated, but I think typically a fund manager will not go wrong over there.
Yeah.
But in credit, you need to be a really, really good fund manager to see that you identify these spaces and the risk is comes down.
Correct.
So could you for the benefit of the audience, because I'm sure that is the reason why a lot of investors don't want to invest in this space.
Right.
How could you actually elaborate more on this actually?
So I think I would want to modify the way you said. I don't think I exactly say it that way.
Yeah.
You said that in fixed income the risk is that you will default and you will go to zero. While equity, you don't say that risk.
Yeah.
The way I personally look at risk is that risk is you expected X amount of return, right? How different was actually return than the return you assume to be. That is according to me the risk you're taking. How volatile the return has been as compared to what we expected. That's the risk according to me. You said in some companies which are bad companies, you can lose a lot of money. Nilesh, you won't believe good companies over the last 5-7 years on marquee names. I don't know whether you follow Twitter closely. There was a Twitter. I saw it yesterday, some 7-8 companies, marquee names. Last 5 year return is zero. The companies are fantastic. They have been growing. Their profits have doubled over the last 5 years. But guess what? The equity market has given 0% return. They are stopped. Because if you buy a asset which is overvalued, maybe the asset is fantastic. They will keep generating good cash flows. But if you buy them at an overvalued price, your returns are going to be low. So I think this thinking that equity mein risk nahi hai, ultimately I will make my money, enough cases to make out that Japan, how many years it took, 10, 20 years it took for the market to become normal. So that's the first part. Second part, somewhere in the fixed income space, people think that it goes to zero. Now, let me give you a very practical example, right? Assume that you are holding 10 bonds of 10% each in a portfolio, and it's a 5-year fund, 5-year closed-ended fund. So at 10, you have 100 rupees, which will give you 10% return in 1 year, so 100 will go to 110. In 5 years, theoretically, if everything is remaining fine, it goes to 150, right? 100 goes to 150. You said one paper goes to default, two paper goes default. Now, the big thing that has happened in India over the last maybe 5-6 years is 2016, IBC came into play. Now, when IBC came into play, the way if a company goes bankrupt, the resolution is much faster. And there's been some studies that, the recovery depends on what asset you hold, blah, blah, blah. Assume that you make a 33% recovery, 1/3 of the recovery, which means that you lose 7. So a paper with 10 goes default and you lose 7 out of it, right? So your 150 becomes 143. What's the net return you made? 8.1%. So you thought that one goes to 0 and you lose a lot of money. Instead of 10%, you make 8.3% return. So it's I'm assuming that one goes default. You make recovery only 33%. Then also you make 8.5% return. So when you think about it, people don't think it logically number basis. You put a number in place, what's the accrual, how much I can lose, your returns can come down. But if you invest 100 over 5 years and that 100 becomes 90 after 5 years, I think that looks to be that something drastically has to go wrong in the portfolio to that to happen. So I think we should look in the context. And that asset I said, if gold can fall by 50%, silver can fall by 75% in 5-6 years, equity can give you 0 return for a long period of time. So that is one more asset class. It can give you high returns, it can give you low returns. So then it's very critical is that how do you design that portfolio? If you design a portfolio which gives you high risk and high return, the return expectations are high, the risk can also be high. On the other side, if you create a portfolio where it's moderate risk, and then return will also be moderate. So the good part about alternate fund is that the entire risk spectrum is there for you to choose, right? You can choose a high risk, high return, moderate risk, moderate return, low risk, low return. Whatever suits the investor, I think they can pick and choose, which is not the case earlier when there was only mutual funds where you could most of the mutual funds only invested in the AAA rated securities where liquidity is very high, the risk is very low. If somebody says, no, I want to take some higher amount of risk with extra amount of return which can come up, there was no platform earlier because tax advantage was only with mutual fund. Now you have that platform ready. So I think this market is going to see a significant increase over a period of time. And more importantly, when the market gets more mature, over a period of time, more risk processes come in place, the chance of things going wrong is less. IBC becomes more powerful. If the recovery is 33% now, on average, it can go to 40-50%. I think all that's a positive over a period of time. So I think in this a world which is, we call it VUCA or something like that, volatile, uncertain, something like that, right? Which means that if the markets are so volatile, world over so many things are happening, you cannot afford to take a concentrated bet, or else you should be expert, right? Warren Buffett says he only invests in equity. If you are expert in that area and understand it extremely well, you can take a concentrated risk. Otherwise, for normal investors, I think that asset allocation becomes a key tool to diversify their risk.
Now, coming beyond other asset classes and specifically focusing on credits, actually. And, we've made this as credits because specifically that's one space where I guess, even as advisors, a lot of advisors also don't understand this space. One question to you is, in credits, what is the opportunity India has today? In fact, citing that we have a very clean, clean economy as such.
Right.
Most of the banks are, the NPAs are controllable. Most of the companies have very low debt on their books. Okay. How do you feel in this environment? Okay. What is the opportunity India has for investing in credit space? Right. Where are the opportunities?
I think that's a very, very valid question. Let me give you a broad. You said India is in a good space or
low debt,
a sweet spot. Let me quantify. Fund managers have this habit of quantify everything. So if somebody says, you're saying India is in a sweet spot, why is India in a sweet spot? How do you quantify it? So the way any fund manager would look at it is like, what are the key macroeconomic variables of India and how are they shaping up? So if you want to look at a key macroeconomic for any country, inflation, current account deficit, fiscal deficit, forex reserves, growth. So the 5 key parameters. How are these 5 parameters behaving? That will determine as a country, are we in a sweet spot or are we in a tough spot? I don't know whether you recall 2013 when we were quote unquote called a fragile five country, which means that all the large economies in the world, there were five economies which were supposed to be fragile and we were one of them. Why? Our inflation used to be in double digit. Our current account deficit was close to 5. Fiscal deficit was extremely high. Forex reserves was low and growth was getting impacted. Can you imagine from fragile 5, today we are the fourth largest economy in the world. Current account deficit significantly under control, close to 1%, plus minus 0.5. Inflation, gone are the days of double-digit inflation, right? Inflation is the big thing which happened, I think it was in 2016 or 17, when RBI signed that inflation framework, saying that we'll make sure that Government of India gave a signed mandate to RBI saying that you need to manage the inflation 4% plus minus 2%. Fantastic thing. Inflation under control. Current account under control. This new government which came in 2014, they have been very, very tight on fiscal deficit. Despite COVID, despite so many countries going way above on the debt, India managed it quite well. Now we are close to 4.4% and coming down on the fiscal deficit side. Currency, I think today we at $700 billion, we may be the fourth largest forex reserves in the world. I think behind maybe China, Japan, maybe Switzerland, and we may be the fourth largest economy in the world, going to be third sooner, with US being at $30 trillion, China being close to $20 trillion. We are at 4.2. I think Germany is some 4.8, 4.9. So in a couple of years, we'd overtake Germany. So if you look at all the key parameters, current account, fiscal, forex reserves, growth, inflation, we are standing tall. So that makes the country as a whole, the top-down approach, a very stable or a good country. And the best proof of, may not be the best proof, we got upgraded from triple B minus to triple B. We had not seen for many, many years back. So that shows, that should give some confidence to the investors, saying that you're investing in a country where the macroeconomy is doing good. Now, if you want to quantify what does it mean, it means that the cost of debt and cost of equity for a country where the macroeconomic variables are good will keep coming down. So that's the first key thing, that cost of debt and cost of equity keeps down, which is good for the company as such. Now, if you look at the balance sheets, obviously banks in India had some issues and then cleanup happened. Today, the banking sector is sitting at a pristine balance sheet with significantly less NPAs. Corporate India has deleveraged significantly. So you have fantastic corporate balance sheet, fantastic banking balance sheet. And if you look at NBFC, this is a sector which we track very closely. So NBFC was a sector which was kind of always been seen at a bit negative. Somebody said, there's no other industry in India which is called non-something. So NBFC is non-banking finance company, right? So this is not the best way to describe them. So the capital adequacy requirement by RBI for NBFCs is 15%. It means that you need to maintain at all points of time minimum 15% capital adequacy ratio. Guess what is the average of all the NBFCs capital adequacy? Is 22% plus. So NBFC sector, which was supposed to be a slightly vulnerable sector, is standing tall today with a 22% capital adequacy. There's one interesting data point that investors will like who track this market closely. Now, what RBI does, typically RBI comes with a financial stability report every 6 months. We'll talk about how stable the financial markets. December 24 report, they come with an index called the NBSI index, non-banking stability index. They said, we'll find a way to create an index of all the NBFCs put together. The index value can move between 0 to 1. If the index value is closer to 0, according to them, the sector is very stable. If it's closer to 1, the sector is not stable. Incidentally, they also gave that same data of that index for last 7-8 years back. You will be surprised to know that today that index is significantly lower than what it was during COVID times and during second COVID wave and so on and so forth, which means that RBI, which is the supervisor for NBFCs in the official report, is talking about how stable the NBFC sector is. So if your NBFC sector is stable, your banking sector is stable, your corporate India is doing fairly well, which means that broadly the risk for India and corporate India is manageable. But having said that, obviously you will have some companies which will be high risk, and so you have to be very careful. But at least broadly, from the top-down approach, the risk is looking fantastic. Now, if you look at the number of companies in India, I think the CRISIL has done one study where I think there are 7,000 plus companies which are rated in India, out of which half of them, maybe close to 3,500, are rated single A and triple B. You'll be surprised to know that the median rating in India, I think, is approximately triple B. Of all the India corporates put together. So there's 50% of the companies in India which are rated triple B and single A, typically don't get funded by mutual funds because mutual fund would prefer triple A, not from insurance companies because insurance companies by regulation cannot invest in triple B and single A, provident fund, large pools of capital which are government, which are retirement funds, they cannot invest. So those are a good set of universe for the alternate funds to look at. And we have 3,500 companies there.
Hmm.
So I think that if you put the numbers in place, I think that the scope is significantly more, and more importantly, a 4 trillion economy like India, growing at a 10% nominal GDP growth, which means adding $400 billion of GDP every year. By the way, it's equivalent to a Philippines economy. We add one Philippine economy every year. I think the universe is significantly large for all set of players, including credit players, to participate in that growth.
Wonderful. There's a case for credit specifically in India.
Yep.
But is there are there ample opportunities? Because I'm sure there will be upgrades.
Right.
Typically what we are looking at is a double-digit kind of a return.
Right.
Okay. Are there opportunities in this space? Citing that India is doing well.
Right. So you are the best person to know how much opportunities is there. There's a very easy way to find out. You look at your customer's portfolio. How many of them holding how much in equity, how much in debt, and how much in credit? You will get the answer that the credit will be a very small portion of the entire portfolio.
Almost zero.
Almost zero. So that shows how big the market opportunity is. So this typically happens that when asset class does well, a significant amount of money starts going there. Then obviously some volatility comes in. Then you look at the asset allocation and then say, oh, I am low in this asset and I can put more money there. I think distributors like you or advisors like you are the first one to know that is the market now skewing to one side. So if you think most of the investors are in one side of the asset allocation, it means that a significant opportunity arises on the second side. A time will come when markets are so volatile that more money moves in there. Then you'll realize, oh, all my incremental money is coming there. Maybe this is the right time, right place. So I think opportunity is immense, because I think in investors' book, credit is not playing a big role as of today. And because maybe 2018, for example, was a bad time for credit. Now, why bad time? I think so as I said, every asset class can go through cycles. 2018, very peculiar thing happened. The two or three large AAA companies went default. Now, in India, a AAA rated company has a significant more AAAs definitely have more meaning than in every country. In Indian context, because a significant portion of retirement money, insurance money can go into AAA. Therefore, something happens to a AAA company that impact is significantly more as compared to a BB company defaulting or a BBB company defaulting. In 2018, we saw a couple of names there, and I think that was, according to me, a more critical factor, that it shook the system, saying, oh, AAA companies can default. Then obviously the markets became tight, and then it impacted second and third and so on and so forth. Now I think we are much past that. I think in today's context, I think we are reasonably good on the macro space. Having said that, we'll be very careful on each individual companies. Each companies have their own risk, and you have to be very careful what risk reward you're chasing. If you're chasing high yields, obviously you should understand that comes with high element of risk. But on an overall basis, I think on the twin balance sheet, corporate India, NBFC sector, government of India, I think we are doing reasonably well on a top-down approach.
Wonderful. I think one question which I wanted to ask you was related to what happened between 2018 and 2020. Lot of fund houses, and I think it was more to do with the regulatory reasons also. Okay, because that time I think you didn't have any a cap on unlisted, or papers, and we saw a lot of delinquencies happen. In fact, across fund houses, and I think one answer you have already given. That a lot of AAA became a default, junk rated, and even a fund manager cannot do anything in that case. But apart from that, was there any other reason why you feel, because the structure was, and there was a lot of money. I'm sure you'll agree to it, because we have been through it. Is that like credit was giving you equity returns. Okay, when you get 10% and 9.5%, 10% kind of returns. A lot of money was chasing that space.
Right.
In fact.
Right.
So what has changed between then and now? In fact.
So I think a lot has changed over the last many years. The first thing is now the two risks on the fixed income market. One is the credit risk, second the liquidity risk. So earlier, the open-ended funds were taking credit papers. But the underlying market was too liquid, but the fund houses said that we'll manage it, we'll keep some liquid papers, we'll keep staggered maturity, we'll take retail money, we will have exit loads and so on and so forth. And 3 years anyway, investment gets a tax benefit, therefore they come with a 3-year investment horizon. And therefore it was kind of manageable for a long period of time. COVID came, and many of these assumptions which you made suddenly obviously got impacted. Now, I think what's happening is that all the credit papers are going into a closed-ended structure, which is fantastic, which means that you're not taking liquidity risk, right? Because there's no open-ended structure. Most of them are not open-ended, which means that you don't need to worry about liquidity of these papers. So that's the first part. Hold till maturity. Good opportunity comes, you can exit, but otherwise you hold till maturity. The second thing, I think IBC has come a long way, and every year it has been improving the way it has been functioning. A strong IBC structure, I think, gives that additional comfort, saying that if by chance something goes wrong, you can have recovery, and the resolution can happen much faster as compared to what used to happen earlier. And obviously the market has grown, it has got developed, more players have come in, all that is slowly adding up in the positivity. You made that comment that 1820 many got defaulted. My sincere request is that you look at the returns after the default and the recovery.
True.
Right? So while it was a big impact, I'm sure it was a big impact, but the net return after the default and some recovery from the default, we will surprise you that, oh, you actually got that much of return.
No, in fact, I've seen the franking schemes, and the returns, the only thing was the illiquidity portion. People had to wait. But I don't think people ended up getting no returns or zero returns or negative returns. They did end up getting a decent return. Actually. And I think that's the reason why regulation must have changed related to the unlisted space and the liquid paper space.
No, unlisted, you mentioned unlisted a couple of times. I think that's a big point for private funds. So typically what happens, the many ways to differentiate what is a private vehicle and what is a public vehicle, or what is a mutual fund and what is alternate funds. I think if you want to very simplify for your investors, public funds or mutual funds are the funds which can give you liquidity very quickly. Private funds cannot give you liquidity very quickly. That's one big difference, right? I'm sure there are many differences. The second big difference is that private pools of vehicle can buy unlisted papers or unlisted companies, while the public, because they want the public funds in liquidity, therefore they will typically buy in a listed space. Now that is, according to me, a big positive for alternate funds, because they can buy unlisted. So what used to happen earlier, maybe 20 years back, then maybe 10 years back, a company has a fantastic idea, wants to grow fast, doesn't have too much of equity, wants to raise equity. They'll typically go to IPO market, they can raise equity, all the public funds get invested. Over a period of time, all the public funds will participate in the journey of the company from small to medium to large. Now what happens? You have a fantastic idea. So Nilesh comes with a fantastic idea. This is my idea and I'm sure this will work. You don't go to a public fund and do IPO. You go to a private fund and say, let me partner with the private fund. Private fund will handhold you, provide some money, and will participate along with you the growth of from small to medium to large. Once they become large, then they go to a public market. So the return journey from small to medium to large is not available for public players. Typically, I'm sure exceptions can be there, which is available for private players. And same true with world over. So nowadays, for a company to come to IPO market, typically they will come at a time when they have grown to a decent size, which means that earlier part of the gains goes to the private vehicles. Having said that, risk is also high, because when you're private, when you're small, when you're unlisted, the risk is also high. But if you want to participate in smaller companies, which are unlisted, you need to come to a private pool of capital, whether it's debt or equity. So therefore, unlisted, if you think that should be a part of your portfolio, there's no way you can participate in them unless you look at a private market. It can be private debt or it can be private equity. That is one more reason for asset allocation, saying that X amount of money is in my public funds. This amount of liquidity, I can compromise on liquidity. I can stay illiquid for 4, 5, 7 years, depending on is a debt fund or equity fund. I'm willing to take that extra risk, but I want that extra return. You will have to look at a private pool of capital. That's one more reason I think over a period of time, more and more companies taking the private route to grow. So much less opportunity for the public funds and such more opportunity for the private vehicles. So that is one more reason why you should look at private funds, both fixed income and equity, over a period of time.
Okay, quickly, one question is one, who should invest, and whoever can invest, what is the percentage of allocation you feel among the fixed income space? Okay, should they allocate to the credit space?
So Nilesh, you're asking me a very difficult question. I am not expert in that.
I'm trying to make you complicate you.
So it's your job, frankly. But I can tell you how I look at it. Right. For someone like who has a risk appetite like me, I'll say, first thing, I am sure that the world is very volatile. I need to do asset allocation. And in my mind, asset allocation means investing in assets which are low correlated between them. If the two very highly correlated asset, then it's not asset allocation, because both move together, up and down together. So first thing, the basic assumption is that I am not expert in all asset classes. Therefore, let me diversify and do asset allocation. That's the first part. Second part, depending on my risk appetite, I say this is my equity portion. and this is my fixed income portion. Broadly, in my mind, it can be 60-40, it can be 70-30, it can be depending on where you are in. Once I decide on that, this is my personal view. Again, you have to do this job for your investors.
We will have the disclaimer in place.
Yeah, sure. You should have, because everyone has a different risk appetite.
Yes, absolutely,
you have so many investors and different risk appetite.
Yes.
Once you decide this is for equity and this is for fixed income, I will say this amount of equity, I don't need liquidity too much. This amount of debt, I don't need liquidity too much. So the liquid portion of both equity and debt goes into public funds. Depending on I want a mid cap, small cap, large cap, flexi cap, I put in equity. Depending on low duration, high duration, I put in money market fund, I have a corporate debt fund, and so on and so forth. Now it means the portion where I can compromise on liquidity. If asset class can give me higher returns, I'm willing to lock in that money for say 4 years for a credit fund and maybe 7-8 years for the equity fund. If I can do that, then I look at private funds for this. Now, the good part about private fund is that the spectrum is wide open. You can choose what risk you want and what return can you expect from that. So depending on your risk appetite, you choose between the private funds, low risk, medium. Low risk means not lowest risk. Obviously, low risk means within the alternate space, it will have a low risk, medium is high risk, and then you asset allocate. So the first thing I would want to suggest to you that look at equity, debt, commodities, real estate as 3 or 4 asset classes, and put a broad number depending on the risk appetite, the time horizon, where do you want to put in money. Within that, how much should be in public, how much should be in private, should be based on your liquidity needs and your risk appetite. If somebody says my liquidity need is not too high, but I don't want high risk, then you better be in a public fund, despite you can...
Or maybe I don't want volatility, even though they have a 4-5 year horizon, but they don't want volatility. Then this
I think volatility actually, while theoretically volatility will be the same in both cases, but here because it's hold to maturity and it's not open-ended for application redemptions, technically if you stay put for the entire time period, the volatility will be lower for you as compared to a public fund where maybe comes up daily and you can see going up and down. But I think it should depend more on your risk appetite and whether you can take that illiquidity in your stride. If both, then obviously you should look at private funds, and then depending on your risk appetite, you choose one of them.
Wonderful. Now, you have come out with a new offering, the AIF, the credit AIF, and would you like to, broadly tell us a little about it?
So the first credit AIF we launched, first close was on April 28th. This was a NBFC focused credit AIF of ours, which means that a good portion or maybe 100% of the money can be invested in NBFC sector. We think that NBFC sector is a fantastic sector if you want to participate in the consumption and growth story of India, right? But a couple of things, NBFC is again a vast space. You will have different kind of NBFCs, something in infrastructure, lending to corporates, lending to real estate, lending to retail. We like the space where NBFCs lending to retail sector is what is to our liking. So we did the first close, we invested all the monies, we are on the road for the second close. So that's a one fund which we think if you want to participate in the consumption and growth story of India, that's a good space to be in. The full details are there. If you want us to connect, we can connect on a private basis because it's a private fund, it's not a public fund. You should have the risk appetite of BBB and single rated companies. You should have a risk appetite of waiting. So this was a 4-year fund, so you should be able to wait for 4 years. The second close is we plan to do it in the next couple of months. So we think that if you want a slightly higher return than what the public fund is giving you, you can take that extra limit of risk. And you can wait for 3.5 to 4 years in a closed-ended structure. This may be a good option, which I am sure, depending on your risk appetite, you should consider that fund.
Wish you all the best for your offering.
Thank you very much,
I'm
Nilesh.
sure it will be a great success. In fact,
thank you very much.
Thank you very much.
Thank you.
Cedrus Wealth Partners, orchestrating distinctive wealth management proficiency since 2007. We deliver transparent, unbiased, and comprehensive investment solutions. Today, we manage more than 3,000 crore rupees in assets, proudly serve over 1,000 families and 3,000 individual investors, and with a team of 26 experienced professionals, we help our clients achieve their financial goals. Our 360 degrees wealth management approach integrates investment planning, risk management, tax optimization, and legacy planning. We focus on the 4 essential pillars of financial planning to create a strong foundation for your financial future. Our advisory process is mutually exclusive and collectively exhaustive. We provide uncomplicated advice. No ULIPs, no NFOs and no structured products. Our portfolio offerings include managed equity solutions for superior risk-adjusted returns, novel offerings including hidden gems that provide pre-IPO and niche investment opportunities, and alternate investment solutions like private equity, real estate, private capital, and multi-index investment strategy. From humble beginnings in 2007, Cedrus has grown with a commitment to innovation, excellence, and trust. With a global presence in key cities, Cedrus continues to redefine wealth management with innovation and trust. Discover the Cedrus difference. Your financial success is our mission. Contact us today to begin your journey.